Good day, everybody. Well, there's a lot going on at the moment, so we need to sort of dig into why we're seeing this sell-off in stocks, and we need to understand the drivers of stock markets. Now, this is a really, really fascinating study. We need to sort of look back to what took stocks to the highs that we saw, and we have to look back to the 2008 financial crisis because the driver of equity, the equity rally from 2008 to 2021 was the fact that central banks were slashing interest rates to zero or below in some cases. Huge bond buying programs, which were called QE, that's quantitative easing, which pushed yields down across the board. And we saw yields collapse in just about everything. And therefore, there was quite a long period of time where many assets out there had very little return at all in the financial markets. So this gave rise to the idea of T.I.N.A. There is no alternative to stocks. Now, that is a major driver. And the fact that there was no yield anywhere took stocks up. Look at the Wall Street Weekly here. This is a chart since 2009 on the right here. If you overlay that chart with the increase of the balance sheet at the Fed, then it's almost a mirror image or almost the same overlay. So therefore, one of the biggest things that drove stocks up here was low rates and QE. So therefore, we need to have a look at what changed. Now, what we have seen change is the dynamics. So the very structure of this rally has actually been reversed in the recent times since Russia invaded Ukraine. This was a major game changer. And what we've seen is too much money chasing too few goods, which is a supply issue, which gave us inflation. And therefore, what we had was the consumer price inflation rate, particularly in the US, Euro, and UK, just took off. And unfortunately, the central banks decided that this was going to be transitory, which of course was nonsense. It was never going to be transitory when, supply-driven issues were not going to go away. So we saw this massive supply shock. Central banks were suddenly way behind the curve. Now, the problem is this actually impacts the curve of the US interest rate curve, because whilst interest rates were going up in the short end, impacting the short end, the 2-year, the 1-year, whatever, the 10-year was worried about growth, because as they were behind the curve, people thought, well, how can you get a soft landing when you're chasing inflation? The only time the Fed has ever engineered a soft landing is when they've been preemptive and in front of inflation. So there are real risks here. Now, equity markets don't like recessions, particularly global recessions. So we've seen central banks rushing to remove the boost that they had given markets and the real economy through all sorts of fiscal boosts. We saw them with QE, we saw interest rate cuts. And, what we've got now is central banks beginning to shift rates quite a lot. So if you look at where we were on December the 31st, 2021, on the left-hand side here, we've got the central banks on the left, where we were at the end of 2021 to where we are and the size of the expected hikes in September. So you can see quite a big move still coming. We've seen 3% plus in some, 3% in some places, and others moving towards that sort of level. And yields are actually even higher in some places as well, particularly in some of the short ends. But interest rates obviously, impact bond yields. Yields matter with everything from financing debt to equity markets. So, these global yields are rising actually extremely fast. And we're seeing some pretty aggressive hikes led by the Fed, but from others as well. The RBZ, we've seen the Bank of Canada doing 100 basis points, the Riksbank in Sweden doing 100 basis points, the SNB doing 75. We've got some real movers here. So US 2-year yields have soared to about 4.5% almost, which is just staggering from where they came from. But if you look at what investors can now earn from these bond yields, then dividend yields on the S&P, for instance, are less attractive. So this is a major game changer, and it shifts the way that asset managers allocate their funds because they want some of this yield in bonds now. So on a general rule, if we see interest up and bond yields up, stocks often get hit, and obviously vice versa. And with quantitative tightening and higher yields, stocks often take a move down. Quantitative easing would see stocks up. Now, we've seen a lot of talk today about the Bank of England with possibly not moving into QT now, which is why we've seen a few things turn around. But there is a real danger here that central banks miss the boat. They are catching up, and it's had the impact that we've seen on stocks, commodities, the dollar, and everything else. And, you know, this is a fundamental shift that we have to bear in mind. And it's quite easy to sort of look back and see why we've seen these sort of moves, because the dynamic has been playing out since, well, to be honest, since late 2021, but 2022 has been a doozy for all this. Stocks are under serious pressure. We're seeing a bit of a bounce today, but overall, we took out the mid-June lows that we saw recently. Some analysts are even suggesting 2022 lows for stock indices may not be in place already. I can see why. Again, we may have a bit of a rally today, but is this a bear market rally? The risks are out there. They certainly are, because we've got a fundamental shift about the support mechanisms that were in place for equities to make those highs back in 2021 have been taken away, and that matters. And based on the yields they pay, bonds look almost a better value than stocks do in certain cases. But volatility is extraordinarily high in bond markets, and so they are risky. It's not easy, but you can see on this chart on the right here, the bond yield in the Treasury of the 10-year in the US is actually more rewarding than the S&P dividend yield. So the moving global yields is important, it's been large, and has a dramatic impact on decisions made by equity investors. We're at the end of an era here because we've got a situation where cheap money, cheap labor, cheap goods, cheap everything has gone. The low-hanging fruit is no longer there. Buying the dip made everybody money all the way through for the last 10 years. That market has changed now. So we need to understand the drivers of these stock markets and what they can do to undermine the security of the rally. And to be honest, it is an end of an era. I think things have massively changed. And if you don't have bond markets on your screen, then to my mind, you are flying blind. You will not fully understand what is the driver of these markets unless you have bond markets on your screen and you understand bonds. It's vitally important. So in the real time, we've got stock market headwinds everywhere. There's a danger of recessions in many economies. You know, equity markets are going to struggle if stocks see a global recession coming. You know, demand is disappearing. Look at commodities. We've seen demand droughts in oil, copper, aluminium, steel, everything. Now, they could come back in a whisker because there is a strategic need for those. But at the moment, the markets are focused on demand. And whilst they're focused on demand or the lack of it, let's say, then there is risks out there. And so, you know, below trend growth is a real possibility for some time. Again, that is not particularly good for equity valuations. And I still think one of the threats to equities going forward into Q3 to Q4, particularly Q4, is weak earnings because margins look like they're under pressure. So we got fears of the US economy. But to be honest, the US economy looks stronger than most. It's the best of a worst bunch, if you like. But if you can see the Euro area UK looking really, really weak. And, you know, the US is still in danger of catching down to some of these economies. But at the moment, some of the data is still really holding up quite well in the US. That means a demand for the dollar, more of a demand for some other US assets. But the issue here is that the fundamental dynamics of the support process has been removed. And inflation is a massive issue, but so is growth. So looking at the headwinds, we've got the USA 500 declining on a very broad base. There are no sectors that are really doing that well. This is a concern because it's a broad-based sell-off. I wouldn't say we've seen a massive capitulation yet. That may still be to come. I don't know. But at the moment, it's like a death by 1,000 cuts. We get 1 or 2 days or a morning where we see a relief rally that doesn't hold, and down again we go. And the market is beginning to get disappointed, and there's a certain amount of throwing into the towel on these things. But we've got a lot of concerns for stock traders at the moment. The recession's hurt consumer demand and company profits. That's a given. We know that. But it's happening, and it has to be taken into account. Profit warnings like FedEx recently, they're a global company that is based on a demand issue, and they are actually signaling some real weakness ahead. We need to look at things like that. They're real canaries in the coal mine. They're red flags. And earnings for companies, I don't think the fall in potential earnings into the end of the year have been fully priced into equities yet. That may still be to come, despite this rally we're seeing today. So continued dollar strength is also weighing on earnings. We've got a dollar up 16% is not particularly good for manufacturers in the US who have to export, but it is capping inflation. There's that period in that there's that additional bonus in there for the US. Commodities are priced in dollars. A high dollar makes the rising commodities hasn't really hurt them a great deal. So what we've got here is a situation where the US is still the cleanest dirty laundry basket out there, I guess. But there are issues about what a rising dollar can continue to do. And the dollar can be a bit of a wrecking ball when it comes to other economies. So we need to bear that in mind as well. It's not just what's going on in the US. As we have clearly seen in the UK, there are major issues out there. And the EU also is facing some serious headwinds. So the growth story is as important as the inflation story, and you need to understand that. But also we need to understand what the fundamental support posts that have been removed from equity markets has taken place in the last year. And they are a fundamental restructuring of what drives these markets. And I think unless you understand that, you're going to struggle to make sensible investment choices here. And I think, yes, there's going to be days like today when we see these big rallies. There's chances that central banks may have to step in, but we need to understand what that means. And the markets are extraordinarily fluid at the moment, and volatility is not your friend. We are going to see some wild swings over the next few days. So make sure you understand exactly what's going on, because these markets are not going to be easy.